We're analyzing JD.com, stock ticker JD, to see if its market price is a fair value. JD is the largest stock position that shows up in Michael Burry's US portfolio. It's also trading just $3 above their 52-week low. This is an opportunity to look at the company for lower than what Michael Burry paid. JD's also owned by Chase Coleman, manager of Tiger Global Management, and Christopher Davis, who's interestingly enough a director at Berkshire Hathaway. With just a few super investors in the position, it's still got quite a variety. We're using the Select 6 analysis to look at the most telling financial metrics for JD before estimating an intrinsic value. Then we're giving a final rating to the business. There will be a key bonus metric along the way that just might be the tipping point when analyzing JD for your portfolio. Before we get into these valuable metrics, let's understand JD stock performance. Year to date, JD stock is down 40%. In the last 5 years, JD stock price is down 16% overall. The company's cut by 2/3 from their all-time high in February of 2021. However, since going public, JD stock price is up. Their stock is up 35% over this time. They're compounding at about 3.5% annually, and the company pays out dividends in addition to these returns. Right now, JD pays a 1.84% dividend yield. Their average dividend yield throughout this time is in addition to these returns. JD's trading just $3 above their 52-week low. The company's been more than cut in half from their 52-week high. JD's a large business. They have a $51 billion market cap. But the burning question is, why are super investors like Michael Burry interested in JD? JD.com is a leading e-commerce platform with its 2022 Chinese gross merchandise volume being similar to Pinduoduo, but it's still lower than Alibaba. It offers a wide selection of authentic products with speedy and reliable delivery. The company has built its own nationwide fulfillment infrastructure and last mile delivery system similar to Amazon. It's staffed by its own employees, which supports both its online direct sales, its online marketplace, and omni-channel businesses. Starting with metric number 1, we want their average return on capital in the last 5 years to be above 14%. There are 2 key reasons for this. The average publicly listed business earns about a 7% return on capital. Over the long run, over the course of decades, a stock's likely to return approximately what its underlying business returns. These business returns are captured by return on capital. Looking for a benchmark that's double the average allows us to build in some margin of safety based off the quality of the business. JD's returns on capital, while they have improved over this time, have been lackluster at best. Their highest returns came in their most recent fiscal year, where they earned 5.3% returns on capital. Averaged out over this time, JD earns below average 3.5% returns on capital. This is an X on metric number 1. Metric number 2, we're looking at the company's growth. We want to see 5-year revenue, net income, and free cash flow growth. This metric's all or nothing. All 3 of these need to be up for this to be a check. In this time, JD has more than doubled their revenues. Their earnings have gone from being negative in 2018 to they're positive today, and their free cash flows are up 5 times. While free cash flows can vary year to year, that's why we're going to take an average of their free cash flows later on when we calculate a fair value for JD, so stay tuned for that. All 3 of these are up, meaning this is a check on metric number 2. Metric number 3, we're looking for earnings per share growth in the last 5 years for JD. During this time, we learned their earnings have gone from being negative to they are positive. At the same time, JD's diluted existing shareholders by about 11%. So while that's less than ideal, that's not necessarily out of the ordinary for these growing tech companies. Still, on the back of their positive earnings growth, this is another check on metric number 3. Metric number 4, we want their free cash flows per share to have grown in the last 5 years. On the back of free cash flow growth that has outpaced their shareholder dilution, this is a check on metric number 4. So far, through our first 4 metrics, we have 3 checks and 1 X for JD. During economic downturns, it's overly levered businesses that are at the greatest risk of poor outcomes. We want JD's net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow the company has produced cumulatively in their last 5 years. In all 5 of these years, JD has had negative net debt, meaning they're left over with cash after paying off their debts. The company's also been cash flow positive in each of these years. Right now, JD has $19 billion in cash on their balance sheet, and they produced $17.5 billion worth of free cash flow in their last 5 years. This is a monster check on metric number 5. The company looks like it's in a very strong financial position. As our bonus before we get to a valuation of JD, we're looking at their dividend profile. Right now, JD pays a 1.84% dividend yield. However, people make mistakes all the time by blindly chasing dividends. It's important to stop and look at the underlying fundamentals of a business to see if they're able to support their dividends using their free cash flows, in this case for JD. That has been the case for JD. They started paying regular dividends in their fiscal 2022. The company did pay a special dividend in their fiscal 2021. In each of these years, those were well supported by the company's cash flows. It looks like JD could start returning capital to shareholders, and these returns would be supported by their business. While this is a snapshot of their last 5 years, JD could start growing its dividend into the future. The big metric of them all, metric number 6, we want JD's average 5-year free cash flow divided by their enterprise value to give us a yield above 5%. If this is the case, this will provide a slight risk premium to the yield of the 10-year treasury. It may also offer a reasonable starting point for a valuation of JD. JD currently has a $41 billion enterprise value. This takes into account their net debt position and their market cap, offering a perspective of JD similar to it being a private business. In their last 5 years, we learned JD produced $17.5 billion worth of free cash flow, meaning they produce about $3.5 billion in an average year. When their $3.5 billion of their average free cash flow is divided by their $41 billion enterprise value, that gives us about an 8.5% average free cash flow to enterprise value yield. In their last 12 months, JD produced $2.9 billion. When that's divided by their enterprise value, we get about a 7.1% current free cash flow to enterprise value yield for the business. Both of those are coming in well above the yield of the 10-year treasury. It's also above the 5% risk premium we'd be looking for. This is a strong check on metric number 6. Just because this is the case doesn't mean you run out and go buy the business. This is not financial advice. It's likely this is one of the reasons Michael Burry was attracted to the business. We still want to estimate what JD's worth per share and give our rating to the business. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to analyze JD.com, which takes us on to using a discounted cash flow model to come to an estimate of their fair value. Like any model in any discipline, its outputs are going to be sensitive to its inputs. A DCF model is based off the predictability of a company's free cash flows. That's why we're using a 3-year average of JD's free cash flows, then using historical assumptions to grow these into the future. It's up to you to figure out if these are accurate or not going forward. Assuming JD grows their average 3-year free cash flows at just under 7% annually for the next decade, then assuming this growth rate is cut in half from the decade out from there, if we add in the company's tangible book value, which gives an estimate of their net worth, and if we were seeking a 15% rate of return, which is the rate of return Warren Buffett's looking for in addition to his margin of safety requirements, from today's valuations of JD, it looks like an estimate of their fair value is around $39 per share. That's about $4.50 above their current stock price. It looks like there could be some margin of safety in the business based off this valuation. There are several key points to keep in mind. Number 1, JD has had a low degree of business predictability in its past. This could skew both our inputs and our results. Also, this discount rate is an estimate of total returns to shareholders. Most importantly, this analysis isn't financial advice. It's not a buy or sell recommendation of any security. Consult with a financial advisor before making any investment decision. In just a moment, we'll give our final rating to JD, but we have to address something first. We focused a lot on the quantitative by looking at the numbers, but what do the qualitative aspects tell us about JD's business? Starting with the qualitative factors supporting a potential long thesis. Number 1, JD is now the largest supermarket in China. High-frequency FMCG categories have attracted new customers from less developed areas and can drive purchases of other categories. Number 2, as its first-party business gains scale, cost advantage will lead to lower sourcing costs and higher margins. Number 3, JD.com's nationwide distribution network and fulfillment capacity will be extremely difficult for competitors to replicate. Then the qualitative aspects supporting a potential short thesis. Number 1, increasing e-commerce competition, such as that from short video platforms, might weigh on JD.com's growth and profitability. Number 2, fulfillment infrastructure could be costly to operate, especially as the company penetrates lower tier cities with lower disposable incomes and population densities. Number 3, the new everyday low price strategy, reorganization, and restructuring of the first-party business in 2022 likely leads to weak growth in the medium term. There you have it for a balanced perspective of some of the qualitative aspects of JD. Now it's time for a rating. In analyzing JD.com, stock ticker JD, the company's grown quite a bit in their last 5 years, really led by strong free cash flow and revenue growth. They're sitting on $19 billion in cash, and they've generated free cash flows in all 5 of these years. JD also looks attractive on both current and free cash flow to enterprise value yields. They just started paying a regular dividend in their most recent fiscal year. The company, however, earns very low returns on capital right now. They've also diluted existing shareholders by about 11% in the last 5 years alone. It's worth reiterating this analysis is not financial advice. When we performed our discounted cash flow analysis, if you've done the work and you believe those historical growth assumptions from today's valuations of JD, it looks like a fair value for the company is around $39 per share. That's up $4.50 from the company's current stock price. It would be right in line with Michael Burry's potential purchase price for the company. Combining all the factors of our analysis, JD looks like a very strong candidate for further research. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more analysis videos, comment down below what business you want me to take a look at next time. Thanks for learning about JD.com with me, and have a great day.